Hey everyone, welcome to today's video. We're tackling a big question. Why do so many new traders struggle in this profession? Now, I'm guessing that if you're watching, you're probably already into trading. But here's the thing, without even realizing it, many beginners set themselves up for failure right from the start. Today, we're going to look at the common problems that trip up both new and experienced traders. By the end of this video, my hope is that you'll spot these common mistakes, tricky ways of thinking, and misunderstandings that trip up a lot of traders every day. So stick around and let's dive into the things that could be holding you back and how to avoid them. Let's get started. When people first learn about the Forex market, it looks pretty easy. They see big money signs in their eyes. Starting to trade seems simple, and more folks are trying Forex to make extra money. But here's the catch. The internet is full of ads promoting trading systems that promise crazy profits overnight. They make you think you're a genius for finding their secret. The pitch is straightforward. Buy it, put money in your account, turn it on before bed, and wake up to a fortune. But in reality, you wake up to find out you've lost a bunch of your money, or even worse. Get ready. The Forex world has lots of scams, easy money traps, and false claims. Online marketers are smart. They know how to appeal to your desire for quick riches and get you to buy their stuff. Remember the golden rule. If it sounds too good to be true, it probably is. Understand this? Forex won't make you rich overnight. You can make good money trading, but treat it like any other job and learn the ropes properly. If trading were a surefire way to quick riches, why are so many new traders failing and losing their money? Before risking your hard-earned money, make sure you know what being a trader really means and set realistic expectations about Forex trading. Newbie traders often dive headfirst into the world of Forex without any preparation, and I get it, they're eager to jump into the excitement. But with no plan, no understanding of how the market works, and no clear approach to their trading, the chances of success are pretty slim. Uninformed beginners jump in and play the market without a strategy. It's a guaranteed way to end up failing at Forex trading. Relying on emotions is a recipe for disaster. Without consistency, it's incredibly tough to see steady profits, if any at all. Becoming a Forex trader is akin to starting a new business. Would you start a business without knowing anything about the industry or your customers? Of course not. If you're serious about being a full-time Forex trader, treat it like any new business venture. As a business owner, you do your homework and be prepared for the worst-case scenario. Successful Forex traders always plan for the worst and manage risks wisely. Do yourself a favor. Learn the ropes of Forex trading before you invest your hard-earned money. It's the right way to approach it. In the world of trading, you can be your own worst enemy. Emotions play a crucial role in our daily lives. But if you let them take the wheel while trading, it can swiftly lead to the demise of your Forex account. Thinking you can get rich quick, that greedy and aggressive mindset could erase commas and zeros from your account balance at alarming speeds. Whether you're a newbie or a seasoned trader, emotions like greed, fear, revenge, overconfidence, impatience, and euphoria need to be kept in check. Forex trading is a journey of self-improvement. As you gain experience, you'll learn more about yourself than ever before. Mastering the ability to control impulsive behaviors, dangerous emotions, and irrational thinking is crucial. A single slip-up can lead to a self-destructive move in the markets that you can't undo. Such a mistake can cause significant damage, triggering a cascade of negative emotions that spiral into more consequences, leaving you with empty pockets. You need to become disciplined. Without discipline, these emotions can sneak back into your trading life, acting like a cancer that kills off your budding career. Every trader experiences these emotions at some point in their Forex journey. They never entirely disappear. It's the traders who fail to develop the discipline and control needed to manage their emotions that crash and burn. Overtrading, a sign you might be addicted to Forex. If there's a leading cause for a Forex trader's downfall, it's overtrading. The misconception that more trades led to more money stems from our natural belief that more work leads to more results. It's a notion ingrained in our daily lives, and naturally, we assume it applies to trading too. Due to this more effort, more returns mindset, many traders gravitate toward low time frames and employ high-frequency trading strategies like day trading and scalping. However, these systems encounter two significant issues. First, they operate on small time frames that capture the intraday noise of the markets, making it challenging to read charts cleanly and perform accurate technical analysis. While some traders might argue in favor of these time frames, I remain open-minded. If they were consistently profitable in the long run, I'd be using them. This common mistake seamlessly follows our discussion on overtrading. These two elements work hand in hand to create the perfect recipe for disaster. Based on my experience, many traders who struggle and seek guidance from me are often engaged in trading on low time frames, such as the 5 or 1 minute charts. There's a prevalent notion that these shorter time frames guarantee swift profits with reduced risk, encouraging traders to rapidly enter and exit the market. However, the reality is that low time frame systems sacrifice quality for quantity, opening numerous smaller trades to grab breadcrumb profits. The risk of having a trade open for 5 minutes is not much different from having one open for days, especially with the very tight stop losses used, leaving the trade vulnerable to even slight market hiccups in the opposite direction. Using indicators in trading can be a bit tricky, and I think it's a big source of frustration for many Forex traders. On most trading platforms, you'll find pre-installed indicators like Relative Strength Index, Moving Average Convergence Divergence, Average Directional Index, and Commodity Channel Index. These indicators are kind of old school, made by smart folks many years ago when computers were just starting out in the late 1960s. Back then, the markets were more stable and these indicators worked fine. But today the markets are different. These indicators don't do so well now. I even have a part on my website where I break down how these indicators work and why they can be a problem on today's charts. As a trader who looks at price action, I don't rely on these indicators to make decisions. I keep it simple and just use 2 moving averages to understand the average value, which works well with how prices move. Being smart with your money is super important for a trader's success. However, it's surprising how many new traders kind of guess how much money to risk on each trade and change their minds a lot. These traders end up risking too much on one trade and not enough on another, which makes their account balance swing like crazy and eventually crash. Knowing how much risk to take compared to the potential reward is a big part of managing money. Sadly, many new traders with a money plan tend to risk more than they hope to gain for each trade. It's like they think if they risk a lot, the small profit they aim for will be easy to get. But this way of thinking doesn't make much sense. For example, if a trader risks $100 to make just $20, they need the next 5 trades to be winners just to make up for that one losing trade. And if the next trade loses another $100, they now need 10 successful trades in a row to make up for those 2 losses. If there are more losing trades after that, it can really mess up the account, and the trader might start making even riskier trades out of frustration. Smart traders do it the other way around. They aim to make more than they risk. So even if half of their trades don't go well, they can still make money in the end. This point is for traders who don't want to put in any effort. Some just want to sit back and let someone or something else make all the trading decisions. I'm talking about traders going after magical indicators, signal services, and those get-rich Forex robots. Signal services and expert advisors claim to take full control of your account and make all the trading decisions for you. But going after these things is a dead end. It's not real trading. Signal services are run by traders who can make the same mistakes as anyone else. They face more pressure because they're handling other people's money. While a signal service can give good signals, clients expect consistent money. Sometimes, when the market doesn't give good opportunities, a signal provider under pressure might force trades, leading to quick losses. I've seen some signal providers do well for a couple of months, but when the markets change, they crash, taking all their followers' money. Trading robots aren't much better. These are sold as automated get-rich-quick systems, usually for $60 to $150. They target people desperate to escape financial burdens, but it's a trap. These are often basic systems that rarely work well. Trading robots let traders tweak risk settings. Imagine what happens when a desperate trader turns up the risk dial to the max with a low-quality Forex robot. It's a quick way to lose all your money. If you want to be a successful Forex trader, you need a serious attitude. Stop looking for the easy option and learn to trade Forex the right way. If you found value in this content, remember to hit that like button, drop a comment sharing your thoughts, and don't forget to subscribe to our channel for more game-changing videos. Your support means the world. Thank you for tuning in and happy trading.